for joining the webinar for the 2016 Financially Underserved Market Size Study. We're ready to kick off here, and we'll start with some introductions of our speakers. We'll start off with Morgan Stanley, one of our sponsors. So Cynthia, if you'd like to introduce yourself.
Great, thank you, Teresa. Good afternoon, everyone. My name is Cynthia Wong, and I'm a member of the Global Sustainable Finance team at Morgan Stanley. We are very pleased to have partnered with CFSI and Core Innovation Capital on this year's report, as we have over the past 5 years. And I want to take a moment to extend our great thanks to Eva and Teresa at CFSI and Colleen at Core on this year's great continued partnership. For those of you who are unfamiliar with Morgan Stanley's Global Sustainable Finance team, our group works to incubate, originate, and execute transactions that reach market rate, risk-adjusted financial returns, and also have a material positive social and environmental impact. The firm's activity in this space includes the management of more than $6 billion of client assets towards investing with impact, and we've also committed more than $10 billion in loans and investments to strengthen underserved communities since 2006. And with that, Teresa, I'll turn it over to you.
Great, thanks, Cynthia. My name is Teresa Schmall, and I'm a Senior Associate with the Center for Financial Services Innovation, or CFSI. CFSI is the authority on consumer financial health. We lead a network of committed financial services innovators to build better consumer products and practices through connecting our membership, conducting research, providing consulting services, and encouraging innovation. In my role at CFSI, I work on our programs team on a variety of our financial health initiatives and, of course, this body of research. Now I'll turn it to my colleague, Eva.
Hi, my name is Eva Walkwitz. I'm a manager at CFSI, and like Teresa, I focus, of course, on the market size that we are visiting here today. And I also focus on small dollar credit and financial technology through consulting, research, and other programs here at CFSI. I'm so glad to be presenting our 2016 market size research with you all today. I'll turn it over.
Hi, everyone. Yeah, thank you, Eva. Good morning and good afternoon, everyone. I'm Colleen, and I am a Vice President on the investment team here at Core Innovation Capital. I want to echo Cynthia's thanks. It's been a pleasure working with CFSI and Morgan Stanley on this report, and so deep gratitude for everyone's hard work. So for those of you who are not familiar with Core, we are an early stage venture fund. We invest exclusively in empowering financial services. So what that means is basically companies leveraging technology to build products and services that are 10x more efficient, more accessible, more affordable, more transparent, and well-designed for the everyday American. We think that these companies are not only well-positioned to be incredibly competitive in the market and deliver significant returns, but also can create material value for their end users, whether that's an individual or a business. And from our perspective, aligning consumer value and end user value with enterprise value is a recipe for success. We think that when you're saving people money or helping them build upward mobility, that's a great recipe for having them stick around and grow with you. So that's us, and yeah, Teresa and Eva, I will turn it over back to you.
Great, thanks everyone. We'll start out by just giving some background on this year's market size study. It will be the 6th annual market size study with the full report now available to you online. The study establishes up-to-date estimates of the size of the market for financial products and services used by underserved consumers. And here on the slide you'll see an overview of what is included in the study. There is interest fees and revenue spent by consumers to save, spend, borrow, and plan, the volume of consumer usage generating revenues, projected and current revenue growth rates, and key trends driving market development. This study is jointly created by CFSI and Core Innovation Capital. We also want to give a big thank you to our funders for this report. The report benefits from the strategic input and financial support of Morgan Stanley, And as with all CFSI research, it is additionally supported by a grant from CFSI's founding partner, the Ford Foundation. And now I'll give Cynthia a moment to talk a little bit more about Morgan Stanley's role in this report.
Great, thank you, Teresa. So as I alluded to earlier, Morgan Stanley has a very strong interest in advancing sustainable business opportunities. We recognize that demand only continues to increase for more innovative solutions that help low-income Americans improve their financial security. We are committed to identifying the opportunities that can accelerate inclusive growth for all, and then that starts by providing the best-in-class support to our nation's financially underserved families and residents. Our support for this study stems from the hope that investors, impact-minded entrepreneurs, and policymakers alike can all benefit from detailed data about the underserved market that is unique to this study. And this critical information shows that this market not only exists, but is in fact growing and really illustrates the wide array of business models where technology and financial services can reach the financially underserved market. So, we really are pleased to support and be a part of this partnership with CFSI and CORE, and look forward to sharing this year's key trends with all of you. And with that, Teresa, I'll turn it back to you.
Great, thanks, Cynthia. We're going to shift now to a quick overview of what we'll include in today's webinar. We'll start with some numbers on the findings in the 2016 study. We'll go on to define the underserved market, review size and growth of financial product revenue, and then go over some key trends around payments, small business credit, auto insurance, and reserve some time at the end for question and answer. And now onto the numbers. You can see here that we saw consumers spend $141 billion in fees and interest to use $1.61 trillion in financial services in 2015. This means the overall market revenue grew by $7.8 million, or 5.9%, between 2014 and 2015. And we project that the market will expand another 2% in 2016. To get to these numbers, we covered 28 financial products in 2015, including a few new products around small business microloans and small business marketplace loans, and an initial exploration of auto insurance spending. Here you can see some highlights that we saw in the $141 billion marketplace. We saw the fastest growing products were in marketplace loans, both personal and small business. The products that were declining the quickest were in payday loans, both storefront and online. The largest product segments were subprime auto loans and overdraft fees. And we also wanted to spotlight one product that we did not include in our overall $141 billion number because it's still in early exploration. But auto insurance premiums reached $36.5 billion in 2015. And we saw that on average, underserved consumers paid 26.5% higher in premiums. On the next slide, we'll review who makes up the underserved consumer market. So we define underserved consumers as those that may struggle with 1, 2, or 3 of the financial conditions listed on this slide. The first condition is consumers that are struggling with low to moderate incomes or volatile incomes. We found 91 million U.S. adults struggle with LMI, and 54 million adults struggle with income volatility. Another factor is consumers that are credit challenged or have thin to no file credit with the subprime score. And there are 121 million U.S. adults who fall into this category. And finally, we also focus on consumers that are unbanked or underbanked according to the FDIC designation. And in 2015, there were 67 million U.S. adults who fell into this category. At CFSI, we care about where these underserved consumers align with consumer financial health. So we want to take a minute to talk about that connection. We define financial health as when your day-to-day financial systems help you build resilience and pursue opportunity. And we know that financial health challenges do extend beyond the underserved market that we just defined. At CFSI, we estimate that 57% of consumers, or approximately 138 million people, are struggling financially. And while all financially unhealthy Americans could benefit from higher quality financial products and services, This annual report on the underserved market focuses specifically on that group. We believe that these underserved consumers have the most acute need for financial products and practices to better meet their needs, and that in order to improve their financial health, there needs to be a robust and innovative financial services market that helps these consumers. In this study, we look at the opportunity to improve that market. So we sized 28 products on how consumers save, spend, borrow, and plan in their financial lives. As I mentioned before, we looked at 2 new products in 2015, small business microloans offered by banks and small business marketplace loans. And plus, we had a first look at consumers spending on insurance with a focus on auto insurance premiums. Some products we examined in this report, such as checking accounts or auto loans, are also used by consumers who are not traditionally underserved. And in these cases, we measure the underserved market size with a focus only on the usage volume and revenue generated by consumers that do meet our criteria for being underserved individuals. By accounting for revenue in this way, we allow for a specific examination of spending on financial products and services by individuals who are more likely to be vulnerable to financial health challenges. This methodology helps us pinpoint the opportunity to improve the financial health of these underserved consumers, which we think can be assessed by considering CFSI's 8 financial health indicators that are shown here on the right side of the page. A quick note that this study is not a commentary on the safety, quality, or appropriateness of specific financial products, nor is it an endorsement of market well-being for providers or financial health impact for consumers. Rather, it's a snapshot in time of the revenue and volume generated by how they save, spend, borrow, and plan. And with that, we will shift to Eva for a closer look at the revenue and growth numbers we saw in this year's report.
Thanks, Teresa. So we will revisit for a minute the size of the market to go a little deeper into what that means for each product category that we cover. So as you can see, of that $141 billion being spent in 2015, the largest share went to those using long-term credit, which we define as credit of 2 years or longer in duration. That's typically divided into installments. And this includes products including private student loans, auto loans, and more that we will look at in more detail in a minute when we cover each category separately. The second biggest share of the market was spent on single payment credit, which we define as credit due in one lump sum, typically in 2 weeks to a month, such as payday loans or pawn. And following that, there was also the third largest share at $26 billion spent on short-term credit, which falls between long-term and single payment credit into the range of loans that are typically installment-based or revolving as a credit card and last from a few months to 2 years or continue on a credit card system basis. There was also $15.7 billion spent on payments and deposit accounts, and that includes products purely for payments purposes such as check cashing or money orders, and also products that function as an account, both prepaid and bank checking and savings accounts. In other services, we also size a couple of other financial products, including tax preparation and the fees paid for that, and fees paid to borrow from or cash out early from retirement savings systems. Overall, we've now been sizing this work. This is our 6th annual report, and we in fact have 8 years of data available to really start to look at the longer trajectory of how these categories are functioning in the market from 2009 through our estimates for 2016. And there's a variety of takeaways we can look at in this chart, but one of the biggest, of course, is looking at how much the long-term credit segment has really taken off and grown, especially between 2012 and 2015. And in large part, this is due to the continued growth of subprime auto loans and greater amounts of credit being available to folks with lower credit scores, often with longer periods of time, 5 years or more, to be able to purchase an auto and get a loan for that. At the same time, you'll see that there's significant growth of short-term credit, while there's actually a bit of stagnation and even decline of single payment credit. So those two lines are coming closer to each other toward perhaps a point of convergence in the near future. And we also see more moderate growth in the payments and deposit accounts area and in the other products and services arena as well. So we'll now take a look at each of our segments in greater detail. And the first category we'll look at is single payment credit, on which consumers spent $36.5 billion in 2015. The largest part of this single payment market is in fact spent on overdraft charges on checking accounts at $24 billion. And there's also a significant share spent on pawn, both online and storefront payday, and a small amount spent on refund anticipation checks. And just to define that for a moment, since that product is a little more obscure, a refund anticipation check is a product, add-on product associated with tax preparation, in which the fee for that preparation is essentially paid out of the expected refund that comes back to the client afterwards, instead of at the time of preparation. And for that service, they charge a fee to the consumer that's coming in for their taxes. You'll see that single payment, in fact, overall has been declining as a category, due in large part to the decline of storefront and online payday loans in particular. As we mentioned before, both declining by over 20% this year and projected for 2016, excuse me. So, and that led to a 4% decline overall for this single payment category in 2015, and a projected decline of almost 3% for the current year, 2016. In short-term credit, things are a little more evenly divided between some of the products that are part of this category. There's over $7 billion spent on subprime credit card fees and interest each year, and nearly as much on installment loans at $7 billion as well. Consumers also spend on rent-to-own services and title loans, where their auto title is put up as collateral for the loan. And new this year, as we mentioned earlier, we have included 2 small business products, which also fall into this category of typically lasting from a few months to 2 years. And these are small business marketplace loans and small business microloans. To get into a little more detail on those, a small business microloan is defined as, in this report, as a loan offered by an FDIC-insured financial institution, such as a bank or credit union, and for an amount under $100,000. And typically, actually, the average is quite a bit lower, in the 20s or low 30,000s for those loans, although the cutoff would be $100,000. And small business marketplace loans are a segment of marketplace loans not previously covered, although we do cover personal marketplace loans in this report in previous years. And these are loans typically offered online by non-bank lenders who match sources of capital with those seeking small business loans. And they're typically offered as installments or based on a percentage of sales volume to measure repayment and scale that to how much the business is doing in sales. And this sector of the market grew 9% in 2015 and is projected to grow an additional 2.3% in 2016. Next, we'll look at long-term credit, where much of the market is taken up by various auto loan products on which consumers spend each year for those loans. Over $24 billion, the largest single product in terms of revenue spent in this whole report, is spent on subprime auto loans, and $18.8 billion is spent on buy here, pay here auto loans, which are certainly subprime in a sense, but have an entirely different business model that typically includes in-person payments on a 2-week period basis, and typically have higher rates than even the deepest subprime traditional auto loans in terms of how much they charge consumers. And this is a part of the market that's actually been declining as more and more consumers use subprime auto loans. So there's been definitely a shift away from buy here, pay here in the last few years. In addition, there's a small slice, $500 million, spent on subprime auto leases, although most leases go to folks with more of a prime credit score. And in this category, we also have personal marketplace loans as opposed to the business marketplace loans we discussed a moment ago. And there's $9 billion spent on private student loans. And this market grew in the past year by nearly 13%, and is projected to grow by about 1% more in the coming year, as there is some leveling off happening in the subprime auto loan market projected after several years of strong growth following the recession and pent-up demand for autos, as well as available credit to lend to those consumers. Next, we will look at payments and deposit accounts, and this category has quite a range of products, used though overall for a common set of purposes, and these are to these are to spend, transact, save funds, and hold them in an account, as well as convert funds between cash and other forms, whether to pay or to save or to earn money and keep it in an account. The largest share of this market was nearly $5 billion spent on checking account fees, and I should note that this is checking account fees sans the overdraft fees that we've discussed before. This will be all other checking account fees that are not attributed to overdrafts. There's also $3 million spent on remittance and nearly as much on GPR prepaid cards, general purpose reloadable. And in this category, in smaller amounts, you see we also have about $1 billion spent on payroll prepaid cards, and a very small 0.2 billion, small relative at least to this report, not small necessarily, on government benefits prepaid cards. Those typically have much lower fees as they distribute various benefits such as food stamps, SNAP funds, Social Security, unemployment, and other federal government benefits for folks that do not have or do not opt to use a bank account to receive direct deposit. In this category is also some more traditional and storefront-based payments-only type products that have certainly been around for a long time, including walk-in third-party bill pay, money orders, and we looked a little bit at remittance before, but in addition to that, check cashing, which is still growing a bit as some of those other categories look more stagnant or may even be declining a bit. Overall, this category grew nearly 7% in 2015 and is projected to grow about 2.5% in 2016. And finally, we have two products in our other miscellaneous category of financial services, tax preparation, on which consumers spent just over $5 billion, and nearly $2 billion spent by consumers to withdraw money early as a cash out or to borrow against their retirement savings and the fees paid in order to access those funds. And this market actually declined by 2% in 2015, but is projected to grow strongly by about 35% in 2016. And the reason that's such a dramatic growth rate is, well, there's only two products that we're looking at here, and one of them, tax preparation, is projected to have much higher fees per customer in 2016 than it did in 2015, and that is what is driving that dramatic growth there for this coming year. And with that, we're going to take a look at three of the trends that we feature in this year's report for a deeper dive into some of the drivers of this market.
Great, thanks, Eva. We're going to start with the trend around electronic payments and the cash economy, and looking at if they are friends or foes. So you can see here on this chart the revenue growth rates of the products in our payments and deposits category between 2014 and 2015. You'll notice that revenue grew across nearly every deposit account and payment option. The highest growth was in multi-use account-based products, including checking accounts and GPR prepaid cards and payroll cards. At the same time, though, we see growth in most single-function point-of-sale-based payment products, just at a slower pace. Money orders are the exception to this rule, but it's with only a small decline. This demonstrates that many underserved consumers still rely on older payment models, even as more modern transaction products and traditional bank accounts are utilized. One reason that single-function payment products remain in regular usage among underserved consumers is their role in facilitating access to cash and cash conversion for sending funds or paying bills. So despite the rise of innovation, cash is still king among the underserved. In fact, 2/3 of all consumers reported that they use cash at least weekly in 2015, and underserved consumers are the heaviest cash users. This means that products such as check cashing, money orders, and remittance remain key tools for cash-based consumers to move money in and out of the payment system. Yet, as you can see on the chart on the right side of the slide, likely due to the time and expense required to use such tools, they are not typically used when cash alone will suffice. You can see that check cashing, money orders, and remittance have significantly lower transaction numbers than the other options on this chart. The chart also shows a higher frequency of annual transactions by prepaid and checking account users, which signals that there might be a good opportunity to incorporate more customers into account-based card or mobile payment solutions that smooth the way to using frictionless methods and increase usage frequency. We know that there do already exist many fintech innovations that facilitate the conversion of cash into electronic or ACH-compatible forms of payments with greater speed and less friction, and that there's also increasing access to mobile technology for underserved consumers. This combination aligns with the steady, slow growth in remittance spending, walk-in bill pay in 2015, and the reductions that we saw in the money orders in 2015. It also aligns with the growth that you see on the left side of this slide, where mobile payment solutions have doubled since 2011, and mobile wallets are expected to reach 1 in 5 smartphone users in 2016. Despite that, we think there's still a gap when it comes to the variety of solutions for the process of extracting cash from a banking system to get quick access to funds. There is a great opportunity for innovation to fill this need, which we see is still currently primarily satisfied by check cashing services and fee-per-service ATM models, or left unmet because of full fund availability being delayed in deposit and checking accounts. So with those thoughts on the trend, I'm going to open it up for Colleen from Core Innovation Capital to say some of her comments.
Yeah, thanks so much, Teresa. I think this is some really interesting analysis and takeaways here. Starting with kind of two trends that jump out at me from some of the numbers, which is, one of which is just really robust growth, continuing robust growth in general purpose prepaid card usage. From our perspective, I think we're seeing a large number of new entrants begin to offer customers prepaid cards that come tied with kind of greater mobile functionality, such as mobile applications that allows kind of contextual engagement with my money. I think looking at kind of most common use cases in and around mobile banking and those that are transacting digitally via phone with their finances, it continues to be functionality such as understanding your cash position in your account, being able to move funds between accounts in real time, and ultimately just sort of exert greater control kind of at the moment of transaction in your financial life. And I think we're seeing kind of app-linked prepaid cards taking that to a next level in terms of proactive alerts and even an opportunity to kind of create synthetic allocations of funds that sit within a prepaid card that again allow a consumer kind of greater control over how they're thinking about cash that is available. I think it's interesting just to contrast this with payroll cards. Obviously the growth in payroll cards makes perfect sense, right? It is extremely inefficient for companies to cut physical checks to those individuals who are on payroll but do not have a bank account and therefore cannot set up a direct deposit relationship. So perfect economic sense that we're seeing growth in payroll cards. I think there's a really interesting opportunity with GPR to serve an analogous consumer who is not quote-unquote on payroll, i.e. they are a contractual worker. A macro trend that we're really interested here at Core is this secular shift from kind of a full-time W-2 status worker to a much more contingent contractual worker. And in those instances, those individuals typically are not on payroll, quote unquote, and you need a new mechanism by which to manage payments to them. And these can be, in some instances, thousands of workers at a company. And so you can imagine kind of the OpEx that is involved in having two parallel kind of payout processes. We're seeing companies begin to leverage prepaid cards and linked applications as a method to not only enable companies to pay out those workers more efficiently, but also give those workers, again, greater insight into their funds and control over their funds, and in some cases even enable real-time payouts over prepaid and debit rails, and basically allow individuals to access their earnings as they earn, which is a really interesting innovation. Just two other quick thoughts here. I think it's fascinating to me to see, there's clearly robust growth in mobile wallet utilization, but thinking about kind of how people are transacting digitally is interesting to me. For example, remittance, which seems like a very logical mobile use case, is one of the least utilized mobile payment functionalities. I think it's worth pausing on and reflecting as to whether that says something fundamental about demand from the consumer or simply the state of current, the quality and experience of current mobile applications in the remittance sector, and whether or not there may be other structural issues such as linking mobile remittance applications to, for example, cash-in functionality that could be suppressing growth and utilization there, because we do see actually fairly robust growth in mobile banking and mobile wallets for bill pay. And so it's interesting to see that robust utilization in bill pay, but not necessarily in remittance. And so I think that's worth pausing on for folks in the space who are thinking of potentially building more optimal solutions. And then finally, cash. I think the fact that we still see cash spending to be so dominant, to me, I think there's two major takeaways here. I think one is that consumers want control. There's something about the physicality of cash and the ability to spend literally, what you have that I think customers who live on sort of a tight financial margin really like. And so again, as we begin to think about building digital payment tools, how do you kind of replicate that sense of control and even support the consumer as an agent to make them utilize their funds in the most optimal way? I think it's interesting to kind of bring that principle into the digital realm. And then finally, I think it's infrastructure, right? It's easy to forget that a very large number of merchants and offline institutions continue not to accept card payments. They will be cash only. And so if this customer continues to transact in regions in which there's a high concentration of merchants that only accept cash payments, they're going to continue to need cash to transact. And so it's just interesting to think on the enterprise side, do we expect greater proliferation of lower cost credit card and card processing terminals, such as obviously what Square has done with many small merchants. If we expect that trend to continue, we may see some reduction in cash spend as it simply becomes easier for consumers to keep all of their value in electronic and digital form.
Thank you, Colleen. From there, we're going to look at a second trend from our report this year, which is tapping alternative credit sources and asking, is it personal or just business? So these are two of the newest products to be sized in this report. Of course, these numbers are also included retroactively back to 2009 to get a sense of what they've been doing in the market all this time in the past as well. And what we're seeing is that while small business microloans of under $100,000 offered by banks and similar institutions are really going up and down a bit, but hovering between $1.5 and $2 billion a year, we're seeing a lot of growth in the small business marketplace loan area. Not surprising that it's growing since that's such a new sector and is growing overall both for personal and business loans. But right now, they're still both relatively small, whereas one is sort of hovering and one's growing. In fact, in 2015, we sized each, coincidentally, both within very close range of each other, around $1.7 billion in consumer spending. But even with both of these parts of the market combined, they only begin to scratch the surface of what small business consumers are seeking in terms of credit. And certainly there's a lot of underserved that not only are spending the combined $3.4 billion there on these two products, but are looking for credit that either they can't get or are getting a smaller amount of credit than they thought when they go looking for that credit, or looking in places that really are even more high cost and have even less clear information in the market about just what that cost is. For instance, this is a big range since there's less clear information here due to lower levels of regulation, but between $3 and $5 billion is estimated to be spent in 2015 on merchant cash advances. And there's also just a lot of evidence overall that in terms of seeking funding, it's not all there, and that's pretty typical, the experience, the modal, if not majority experience for underserved small business owners. 63% of micro businesses reported receiving less financing than they thought, and often, next slide, this also leads to quite a few consumers using personal credit to satisfy that gap in the funding that they're able to get for their business through traditional business credit means. And so this is something else to consider. Looking here on this page, we see the same two trend lines for small business microcredit and marketplace credit, juxtaposed with a few of the ways that consumers often try to access credit when they can't get the small business credit they need through personal means, either through personal marketplace loans, subprime credit cards, or through installment loans, which all, with the exception of personal marketplace loans, which is about the same, make up quite a bit of a larger spending in the market. And so because those types of loans, say an installment loan or subprime credit card, don't record that sort of information, it's hard to know exactly how much is spent by consumers that are indeed not accessing those types of credit just for personal need. But certainly we do know that some of that spending, while we log it here as personal spending on those products, is indeed an invisible form of investment in small businesses. 42% of loan applicants were denied credit or given less than thought, and 49% reported then using things like personal credit cards to satisfy that gap. And so there's definitely both quite a bit of spending already going on in the small business underserved arena, and there's also a lot of opportunity and room to satisfy unmet needs that can't be measured by current spending on small business products. And Colleen, would you like to respond or think a little more deeply about this trend with us?
Yeah, happy to provide some thoughts. This is definitely an area we've spent a lot of time looking into, and I think something that's really notable is just to think about the ecosystem of supply and demand and kind of how that clears. So historically, banks have been the largest providers. Banks and CDFIs have been the largest providers for commercial loans. From a bank's perspective, it costs the same amount to originate a $20,000 or a $40,000 loan as it does to originate a $400,000 loan. And if you look at the distribution of demand for credit amongst small businesses, the vast majority of demand is actually for sub $100,000 and even sub $50,000 lines. So most small businesses actually don't, want to borrow $1 million or $500,000 on a unit basis. Most of them want to borrow $15,000 or $20,000. If you go to a bank and ask for that, it's really tough from their perspective economically to kind of make that math work, because they need to allocate a certain number of personnel hours among their underwriting and the loan officer team. They're just not going to be generating a sizable return on that amount. So, you see sort of this misalignment between what works financially for banks and where a lot of demand lies amongst small businesses. And I think something that the non-bank lenders have shown over the past several years is that borrowers are willing to accept potentially more expensive products in order to be able to access kind of the bite size of funds that they need, and to do so with speed. I think the other notable issue here is that it's not always an extremely fast process to procure a loan from a bank if you're a small business owner, and you're probably already pretty strapped for time and capacity as you're running your business. So I think there's an interesting dynamic here in small business lending that is potentially even echoed in auto lending. When you look at the numbers of folks who end up in buy here, pay here products who are actually prime customers. And that just seems completely irrational and inexplicable that someone with a 720 or 740 credit score would be in an 18 or 20% product. And so you have to sort of ask yourself, what are the structural dynamics around distribution that forces someone to end up in that product, or transparency? But I think it's arguable that there's some similar similar data in small business lending that suggests folks who are pretty well qualified are actually ending up in more expensive products because the infrastructure for lower cost capital just isn't really set up to serve them quickly and efficiently. So we certainly see tech companies that are trying to change that, and we actually see a lot of movement and momentum among financial institutions in partnering with tech companies to be able to provide small business loans as well as other credit products, frankly, at a much lower cost basis, which really allows them to kind of open up the market that they serve and be as profitable on a $20,000 loan as they would be, on a margin basis on a $200,000 loan. So yeah, those are some thoughts on that space.
Great, thanks, Colleen. We also want to encourage all of you listeners to plug any questions that you have into the panel that you have alongside the webinar, and we will get to those at the end of the webinar or follow up with you afterward. With that, we will go on to the last trend we'll be presenting today, which is around auto insurance. So this is a new area for us to explore in 2016, and we looked specifically about the pricing on auto insurance for the underserved and if they're paying premiums or penalties. So we're going to start by looking beyond the $141 billion market, where we looked at auto insurance. And this chart here on the right looks at the spending specifically on auto liability insurance, which is required in every state except for New Hampshire. You can see it shows the difference between what an average consumer in purple, without any indication of lower economic status, spent on auto liability insurance, compared to what an underserved or LMI consumer there in the light blue, with indicators of lower economic status, spent on average on their auto liability insurance. So this spending difference was not based on driving history. It was based on the questions that you see on the left side of the page, which are all tied to economic status, and they were used by insurers to increase rates or decrease rates depending on responses. Nationwide, this increase that folks suffered because of economic reasons amounts to an average penalty of 26.5% on underserved drivers based on those answers. As a result, we think that the $36.5 billion spent overall on auto insurance by underserved consumers presents a big opportunity to better serve these customers. This opportunity rings especially true when you look at the chart on the right side of this page. Here we can see that underserved consumers spent nearly as much on their overall auto insurance, the light blue line, as was spent on the fees and interest on subprime auto loans, subprime auto leases, and buy here, pay here auto loans combined, the purple bars on this chart. This indicates that there's a substantial opportunity to address the needs of underserved consumers who pay higher rates for auto insurance premiums. One state that has capitalized on this opportunity, largely by their regulatory enforcement, is California. So we want to highlight what happened in California as a case study. In 1988, Proposition 103 resulted in a highly regulated auto insurance market in California, and this market made it the only state that had a comprehensive system with a mandate around 3 factors having the greatest impact on insurance rates. And you can see those factors on the left are driving record, miles driven, and years of driving experience. The insurers in California also have the option to propose additional factors, but credit scoring has not been approved to use as a factor, and these 3 must remain those with the greatest impact. Below those factors, you can see the results of some of the longer tail impacts of Prop 103, and it has been a success for consumers and insurers alike. Drivers across income brackets saved more than $100 billion between 1989 and 2011 on lower insurance rates. The California insurer profits remained above the national average at 12.1% compared to the national average of 11.9%. And California rate of returns remained above the national average as well between the years of passage after the law at 8.8% compared to 6.8%. So the profits at that stage in California were 8th in the nation, and the rate of returns were closer to the average, but they were 20th in the nation. And this successful experience of California demonstrates the opportunity for innovation around auto and liability insurance underwriting and pricing practices to create risk assessments that can support the needs of underserved consumers and contribute to overall consumer financial health. And with that, I will again open up the floor for Colleen to add any input on this trend.
Yeah, thanks, Teresa. I think the data here is certainly very interesting, and in looking into some of the underlying studies here, obviously these were interstate studies, and tried, as far as I can tell, to the best of their ability to control for really any other confounding variables that may have contributed to price declines in California while you saw very significant premium appreciations elsewhere, and really control for everything other than regulatory regime. So it's certainly a provocative macro finding that across the 50 states, this study demonstrates trends towards greater competition, a lower rate of increase in premiums and or even price reductions in markets that are more regulated versus less regulated. So certainly sort of a counterintuitive finding that definitely merits unpacking. I think just three things sort of jumps out to me about what happened in California specifically, what might have driven some of these reductions in claims and therefore reductions in costs and a slower rate of premium appreciation. There were really 3 things that jumped out. The first is that California created basically a 20% discount, like a good driver discount, a powerful incentive for individuals to drive in a way that was more moderate and maintain a certain record in order to continue to receive this 20% discount on their premium. Another thing they did was actually mandate that carriers place consumers into the best policy bucket that consumer qualified for, which might seem like an obvious thing to do, but if you imagine a carrier has multiple product lines, and I, as a customer, may qualify for several of them, there was some historical evidence to suggest that consumers were not always being placed in the lowest cost option that they qualified for. And I'll say more about that in a minute. But California basically said you can't do that. You have to put someone in the best product. And then finally, they essentially capped expense ratios. So the overhead of carriers and the degree to which that could be passed through to the consumer in the form of elevated premiums. So what this basically achieved, right, was first you create strong incentives for people to drive more safely, which is going to reduce claims and going to therefore reduce costs to carriers. Second, you actually kind of address through regulation a principal agent issue that exists in insurance, and that is the agents who sell insurance are sort of incentivized to put someone in the higher cost product. And you can imagine that an agent who's selling a renter or lower income policyholder an auto insurance policy is going to be doing math that this person is not likely someone they can cross-sell into, say, a homeowner's policy as well, because they're lower income, they probably rent, probably don't own a home. And so therefore, there's an opportunity to offset that by putting them into a higher cost auto product. And that's just a channel conflict issue that exists in this industry. And then finally, capping expense ratios, again, taking a regulatory approach to doing that, I think what it does is it drives carriers to invest in more efficient infrastructure if they know they can't simply allow their expense ratios to grow and kind of remain very people and paper heavy, right? They're going to invest in greater tech and maybe drive more marginal efficiencies in order to maintain profitability under those expense caps. So those were sort of the few things as I sort of look at the study that jumped out at me that they achieved. And the reason I highlight them, Teresa, is because I think from our perspective, as we look at InsurTech, we're seeing companies actually sort of synthetically replicate all of this from purely a market standpoint without any regulatory assistance. And it's interesting because if you think about the positive benefits of that going, broadening beyond California and moving into other markets, I think there's actually a really big opportunity for InsurTech to drive those efficiencies. So first of all, with incentives, we've seen an explosion of companies leveraging mobile applications, GPS data, in-car, ODD devices, beacon technology, to basically create a data feed around a customer's driving behavior and feed that back in real time to carriers so that they can offer drivers incentives for driving more prudently, and they can also give drivers via a mobile application, via driver performance score, a really nice feedback loop in terms of how they're doing. So, telling you that you broke too hard or you took that turn too quickly. This technology is becoming ubiquitous and extremely affordable. And so I think there's a great opportunity for that to kind of organically mirror this good driver incentive. And it's in the interest, certainly, of carriers to adopt it. And it's in the interest of drivers to adopt it. I think the second point in and around solving the principal agent problem, we see a huge opportunity as the distribution of insurance becomes more digital, and we continue to see replacement of human agents and brokers with digital agents and brokers. There's a great opportunity there for the digital broker to be impartial and to programmatically place the customer in the most optimal plan, and to do so at a lower cost basis of service, which may help offset the fact that you're putting them in the most affordable plan, and therefore probably the commission may be lower. But I think tech has a great opportunity to do that more efficiently than the historical kind of human-enabled channel, and so we're super optimistic about digital brokers being able to solve some of those conflicts of interest. And then finally, on sort of the expense ratio, back office costs aspect of this, we're seeing a panoply of companies on the infrastructure side that are enabling carriers to operate more efficiently, to replace paper-intensive processes with workflows, with software, and really sort of force multiply the individuals on their staff, basically allowing them to do more with less. And so I think as you see broader adoption of that technology, it will help carriers drive efficiency in their overhead, which in competitive markets should translate into lower cost of premium. So those are just a few things that we see on the horizon from a technology perspective that I'm optimistic, even without amenable regulatory environment, could help replicate some of the successes of California in other states.
Great, thanks, Colleen. During that, we actually had one quick question that was around how that process occurred around Prop 103 in California. And it actually did go before the legislature and was turned down, and then the people decided that they wanted it and passed the proposition via referendum. And with that, we will shift to our quick Q&A section, and Eva will moderate.
Hi, so we'll have time for a couple of questions, and certainly any other questions after, we'd be more than happy to contact you offline after the presentation is over. So one question I think that's great to discuss on the call is the fact that among the credit-challenged consumers, we mentioned 121 million U.S. Adults, and that's virtually half the population of U.S. adults. So definitely worth discussing there. You know, that does seem very high, and in fact, it is very high.
Yeah, so the way that we got to that estimate of 121 was we looked at two different groups of people. We looked at the amount of folks that are sized as having poor or low credit scores, so less than a 601 FICO or Vantage score approximately. And we also looked at the estimate of unscorable consumers. So the initial number, the poor or low scores, is around 68 million, and then the unscorable number is around 53 million, which brings us to that 121 million total estimate.
Thanks, Teresa. And you know, it's also interesting to note there was a question around subprime auto loans and why it's growing so high. Is it more people being enticed into the market based on car pricing and structuring of those loans as more affordable? Is it more people who in fact just fall into that subprime bracket these days? There's a few things going on there. One is certainly coming out of the financial crisis and recession, more people did experience lower credit scores and more of them struggled with subprime scores. So there was some additional people in those ranks. Also, there was more available credit in the auto loan market just when credit was a lot tighter for mortgages and other sources of lending out money. So a lot more did go into providing cheap credit to lend out through auto loans, and then more interest in reaching further down the credit ladder to people with lower scores to make those loans. And then also pent-up demand for autos as people maybe held off on large purchases who were struggling with finances during that recession, and eventually then were looking for cars. Most subprime auto loans are actually for vehicles, ranging from a couple years old to much older. So that's also a big factor there, the cycling through of used vehicles as our car stock starts to last longer in the United States and be more durable in the last 20 years. You see more used vehicles that are viable in the used car market. So that relates a little to our credit score question as well, and who those people are, where they're coming from. Another question we would like to, actually, I'm so sorry, we actually have only a couple minutes left, so I think we're going to have to close out. But we will answer those offline, and I'll hand back to Teresa for a few announcements.
Great. Thanks, everyone, so much for attending and for engaging with us. We want to encourage you all to read the full report that has further trends and a full appendix and additional data on the information we just presented. We'll send out a link to you along with this recorded webinar after we close. We will also get back, as Eva noted, to the additional questions that we were not able to get to while we were talking today. We also want to encourage you all to register for Emerge. This registration is now open. You can do so by going to emergecfsi.com. You'll get the best rates at this time, and you can be registered for our annual conference. And finally, we want to extend a big thank you to, again, Morgan Stanley and the Ford Foundation and Core Innovation Capital for all of their help in order to make this report possible. And Cynthia, would you like to say a last word as well?
I'll just reiterate our thanks to everyone for joining us today, and thank you CFSI and Core again for this year's great work.
Great. Well, thanks to all of you for joining the webinar. We hope this sparks a lot of further exploration of the underserved market and the great opportunity here, and we look forward to sharing the full report with you and getting back to you to discuss some of these great questions we see coming in. Thanks, and have a great day.
Thank you all.